Are the geopolitical issues today worrying you and you're thinking, how in the world am I going to survive the volatility, or I'm worried about my portfolio? In this particular episode, Merce and I walk you through a very systematic approach of how you can be designed so that you can get to and through retirement without having the anxiety.
We hope you've been enjoying all the episodes from the Secure Your Retirement podcast. If you'd like to keep learning and receiving these episodes, then hit the subscribe button and turn on notifications by hitting the bell so you receive alerts when each episode comes out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome to Secure Your Retirement podcast. Merce and I are very happy to have you here with us this week, and we're going to talk about something I think that's kind of serious. We always talk about that. When the markets are doing good and everybody's happy, I think everybody feels like, man, the stock market's a great place to be because you can get fantastic returns. And some years it's just unbelievably good. And then you enter into a world where things are uncertain. And you might think back in your mind to 2008 to 2009, major problems in the market. It was the financial crisis that was probably the largest of any of our lifetimes. The market dropped over 50%, even more than what was dropped going all the way back to 2000, 2001, and 2002. And then you truck along and you had other years where there was things that came up and government shutdowns and problems, and that hit us here in the United States and across the world. Then you get to 2000 and you get hit with 2020, and you get hit with a pandemic. And none of us had ever lived through a pandemic. And now all of a sudden the market drops by 30%. Then it comes back, and lots of anxiety in that period of time. Then comes 2022. And all of a sudden, we're seeing inflation unlike we had ever seen for many years or whatever, as far as seeing that kind of volatility. That kind of got under control. And here we now sit, as I'm talking to you right now, with the United States involved in a very heavy geopolitical scenario between what's going on in Iran and the interactions there, and what's going on, and what was going to be quick doesn't seem like it's going to be as quick. We've heard that kind of story before as well. And Merce and I are not bringing this up in this particular podcast to talk about any scenario about right or wrong. We're just going to talk a little bit about how do you position yourself so that when you have these things that come up, all those different things I've talked about, is how can you set yourself up so that you're not so stressed, especially if you're close to or in retirement, and you're not stressed that what is this going to do to my retirement? I talk about it all the time when I'm talking to somebody who's not a client. I said, just listen. You could come in here on any given day whenever there's craziness going on, and you're not going to hear our phones ringing off the hook. And it kind of comes down to why? Why is that the case? Because right now, when you have market volatility, we have a lot of people reaching out to us and saying, I need to talk. I'd like to have a conversation. So, Merce, I'm going to kind of start this off and kind of ask you, when you're trying to talk to somebody and maybe they're not a client yet, or we're trying to help a client get allocated correctly, and we think about all these things that I just brought up that could create anxiety, how is it that when you're having these conversations, you're saying, hey, here's some things that we can set up so that when these things occur, you don't have the anxiety, or the anxiety at least is under control?
Yeah. And we are in a very unique time right now. And I'll reiterate what you said. I think the last 5 years has kind of skewed, I think, the investor's mind as to how the markets work. Outside of 2022, the markets have been really, really good to us in the matter of double-digit returns. So I think there's a lot of belief in the resilience of the market and how it can just snap back, and if we have issues, everything's going to be okay and things like that. But things worked out during the pandemic, where there was the influx of cash into the system that kind of created one of the quickest rebounds we've ever seen off of a 30% drop. So there was action taken by the government that kind of made things happen, and the market recovered the way it did. but that's just not how usually it works. And so we're sitting here in this rather, you know, uncertain geopolitical, this war that we're in, and where's it going to go? How long is it going to last? People are getting more and more nervous, and the question that they ask is, well, how do we protect ourselves against this, or how should we be investing right now? And but we are still getting some people saying, well, I want to continue to be aggressive because we've started to really like seeing those double digit returns. And I think that could be have a fallacy to it at times of let's continue to keep our foot on the pedal. Right now, I think there for a portion of money, I think that's completely fine. I think for a portion of our money, we do want to be very growth oriented to where we can take some risk and very targeted types of risk. But at the end of the day, I think it comes to, a lot of advisors will throw around this term of asset allocation. And as long as we're well diversified in the stock market space, then if things happen, maybe we won't experience it as badly as the stock market. That's asset allocation. Go buy the large cap companies, the mid cap companies, the smaller companies. Go buy, some commodities. Go buy some bonds. Right, bonds in 2022 had major issues. But if we spread out in the stock market, we'll our risk is diversified away. And so I think to us it's that's still valid, but I think to us way more it's about asset location as well as asset allocation. So what does that even mean? Well, where are we putting our money and what types of strategies are we putting it into? And is it all stock market related, or can we get some of our risk exposure away from the stock market? And so when I talk to people, I say, well, could you just imagine here for a second that you're pulling your Social Security, and on top of your Social Security, you need an additional, I don't know, $3,000, $5,000 a month, and could you could just imagine a world where we've got those assets, we've got that cash flow in a place where it's not subject to stock market risk, it's predictable, it's going to make a decent rate of return, bond like or better. And if the market falls out, this side is protected, which means your cash flow for a good period of time is protected, that 5,000 a month that you need to live the retirement life you want to live. And so I imagine that for a second, if you got that covered, are we as stressed out, or are we as worried if the market does have issues? Well, no one likes to lose money, but if I know my cash flow is covered for the next 5 to 15 years, it makes the ability to ride out some of the storms that are going to come our way in the stock market a little bit easier. And so that's where that asset location comes from. So we talk a lot about having an income and safety bucket, and then having our growth bucket. Our growth bucket is various strategies inside of the stock market as well as in the world of private investments. And then in the income and safety bucket, we talk a lot about assets that are principal protected, that are really there for two reasons. And that's why we call it income and safety. It's there to drive my income for a period of time so that I'm never worried about where that's coming from. And also it's there for safety to offset the amount of risk that I'm taking in the growth bucket. When you blend those two together, those two buckets back together, now we've got a really reliable plan when it comes to how much risk we're taking. And it's really reliable in the sense of this year it's war. And in 2020, it was the pandemic. And, a couple years from now, it'll be something else. And so we've got a very nice plan in place that whatever comes our way, we don't have to necessarily react too much because we've got this plan kind of already in place for whatever could be coming our way. So that's a long-winded answer to say, well, how do we handle these conversations? But that's kind of what it is. And so, Radon, you want to talk a little bit about one of those two buckets and kind of help people understand what's going on inside of them?
Yeah, I just had a couple in yesterday actually, and they what we do as a part of when we're getting to know somebody is we will take their current accounts and their current holdings, and we put it into, if you want to call it, a simulator. And in that simulator, it basically says, how would your portfolio have reacted in 2008? How would it have reacted in 2020 or in 2022? And then it scores it or gives it a score. And that score I always relate to like a speed limit sign. So the faster or the higher the number, then the more speed it has to it. So that means it can make really big returns in an upside market, but it can actually drop off a lot in a downside market. To give you some context, the S&P 500 scores at a 71. Now, remember what I told you about the S&P. If I would ask you or tell you what the max drawdown of the S&P 500 is, it's what I just told you about in 2008. About 55% is what we saw it pull back. So if I'm going to be in the S&P with no thresholds and I'm just going to do what the S&P does, I'm going to make really good on the upside years, but I'm going to go, I could have some pretty drastic return or fallbacks. And I always ask folks, I mean, how would you feel if your portfolio was down 55%? And I mean, I don't care who you are. There's very few people I've ever met who said, yep, I'm good with that. Let's just go with that risk. And so what we talked about is like, look, we want to invest, and I'm going to talk about the growth bucket, but I mean, we want to invest to be able to make a good rate of return. And sometimes we get some folks in that says, no, I understand volatility. Don't want 50% declines, but I am okay. I want to get good rates of return. And so what we talked about with them is like, look, what we can do is what we do actually in our growth portfolio is we take a few different types of investments that really aren't talking at the same speed, but they give us good rates of return. But because they're not talking to each other or they don't react at the same way that each other does, it lowers our volatility a lot. So I'll just describe it to you for a second. In our growth portfolio, so let's just take it, our most risky portfolio. Now remember I told you the S&P 500 has a score of 71. So what if I would like to get returns similar to the S&P 500, but I'd like to lower my risk score? How can I do it? Well, what we would do is we would take three different elements and put a lot of diversity into it. But the number one is our core strategy. Now, our core strategy is going to be somewhere around 50 different stocks. And the purpose of those stocks and the reason why we're using stocks is twofold. One, if I buy individual stocks, my costs are really low. I'm not buying a fund that has a cost on it. So I keep my portfolio costs down. But now what I'm going to do is I can pretty much be what the market is. So if I want to be like the S&P 500, or if I want to be like the S&P 1500, or I want to be like the NASDAQ, we are really going to kind of probably be in, most of our portfolios are going to be that S&P 1500. So, but that part of the portfolio is just going to do what the market does. So it has that kind of exposure. So I'm going to do really good on the upsides and I'm going to have some volatility on the downsides, right? But that's looking forward. But then what I'm going to do is I'm going to take another section of the portfolio and we call it our tactical part of the portfolio, which means it is designed to say, hey, I would like to make sure that I'm doing pretty good in up markets, but I want to hedge against downside markets. And so it's a little bit more conservative. It's not going to see the significant downturns when the market drops. And so that offsets the risk quite a bit from my core strategy. And then what we do, and this one is probably one of the biggest things that I think really makes this portfolio do really, really well, but actually lowers the volatility a lot, is we add another layer to it, which is what we call alternative investments or private investments. And in that private investment world, we're going to have things like private equity, private debt. We're going to have, different types of alternative investments that are not correlated to the stock market. So if the stock market's down 10%, my alternative part of the portfolio is not going to have that same volatility. It does have risk, but it's a different type of risk. I always tell people a private investment, easiest one to think about is your home. Can your home lose value? Absolutely. But it's not going to lose value like the stock market would. It's much more stable. But if I buy right types of investments, I can do pretty good. In our alternative investments, it did really good in 2025 as an example, and it does pretty good in a lot of the years, but I just don't have that volatility. So now imagine if I've got two sections of my portfolio that's going to do pretty good on the up markets, but it's not going to have that downside exposure that I would have in the stock market. I've only got one part of my portfolio, the core part, that could have that. So what does it look like? Well, if I do that, what I just described to you, I'm going to take my score from 71 down into the 50s. Now, what that means is that I am going to do pretty good on the upside, but I'm going to significantly reduce my downside. That's what we're all trying to achieve. But that takes a lot of work. It takes a good team of people helping build all this out, watching it on a regular basis, making sure that it's managed correctly. Now, that's just my growth part of the portfolio. And that's why our clients understand they are very well diversified, true diversification. 50 stocks is diversified, but that's not diversified by itself. We have to diversify against different types of asset classes with it not just being stock or bonds, right, on those things. Now, if you take that and you marry that to our income safety bucket, man, do we have something that is going to do really well. So, Merce, if you want to talk a little bit about that income safety bucket and then how that marrying together really just makes a big impact.
Yep. So the income and safety bucket today is primarily driven by fixed index annuities. And, there's a lot of talk about the annuity space and how it works. And, at the end of the day, what we position it as is really something that's going to build safety into our investment structure, which creates reliability, but also it's got to have the ability to make a decent rate of return. And the benefit or the scenario that we're in right now that's creating a good amount of benefit is the fact that interest rates are still relatively high. And there's going to be a lot of conversations this year as to whether it's possible to keep dropping them, because there's a report that I just read today that was around inflation being sticky and actually going up again. And so that's a concern to the Fed on their ability to drop rates. So all that to say is that interest rates are still in a really good place to lock in some longer term investments that are going to provide reliability, safety, and a decent rate of return. When I say decent rate of return, the experience that we've been seeing is, we would expect this bucket to be able to earn somewhere in that 5 to 7% average rate of return. None of that is guaranteed, but just based off of how it's been rolling, that's kind of the expectation. If you're to say, no, I'll just put my money in bonds, if you look at the historicals on bonds are not doing that 5 to 7, and they are subject to interest rate risk. They're subject to downside risk. In the fixed index annuity, when I'm walking someone through it, I let them know. I help them understand the acronym of FIA. So F stands for fixed. I tell people that it's really principal protected. So you can't lose if the markets were to have issues. Your principal is protected. The I stands for indexed. But really, at the end of the day, it's how you're going to earn your interest. The index you're linked to is how you're going to earn your interest. And the A, I say jokingly, it's an annuity, but really, at the end of the day, to us, it's an account. While you may have had a family member that had a different type of annuity, that guaranteed income or something like that, while those have their own space in most cases, all we want is an account with this in the structure that's going to provide the guarantee of no loss and the ability to make a decent rate of return. When we have that vehicle, that cannot lose and is going to make money, we've got a place where we can draw comfortably, and we're not. It relieves this pressure, and in our world, it's called a sequence of returns risk. It relieves that pressure away from us, which is, just imagine for a second, all of your money is in the stock market. You got $1 million. You're pulling $5,000 a month out of that bucket, and all of a sudden you walk through what Radon just described, which is a 50% downturn, and now your million is 500,000. The decision you have to make is, can I afford to still draw $5,000 a month when I have half as much as what I started with? And that's a tough decision to make, and a decision you don't want to make as you're entering into the fun stuff when we talk about retirement, right? So if we want to take that scenario off the table, and we want to know where our income is coming from for a very long, specific period of time. And like Radon said, when we blend these two back together, we can go be risky on one side and go get after the rates of return that everyone's excited about, and the 10s and the 20s% rate of return that we've experienced here in the last 5 years. We can still go get that. But if there is issues in the market, if there are geopolitical, if there's inside the U.S. issues, if there's inflation, if there's interest rate issues, whatever is headed our way, well, we've got our money in different places doing different things for us. And that's what true diversification is, or what we would call asset location, or reduction of volatility through different sources. However you want to phrase it, the more we have our assets doing different things for us at different times, the easier it is to ride out issues like we're sitting in today here in 2026.
So everything we just talked about, by the way, is in our book, The Peace of Mind Pathway. By the way, #1 best-selling, Amazon best-selling book. And so we're super proud of that. And we go through this entire system. So if you want that, you can go to Amazon. It's called The Peace of Mind Pathway. Myself, Radon Stansel, and Merce Tariq wrote the book. Or you could call the office. And if you call the office, we'll send you one for free. So however you'd like to do it, our goal is just to make sure that you're educated. So reach out to us. We'd be glad to send you out a copy. If you have any questions, always also feel free to reach out to us. You can simply go to our website, pomwealth.net, go to the Contact Us page. We're glad to have a conversation. As we say always, we look forward to talking to you again next Monday. Have a great week.
If you would like to find more information about Peace of Mind Wealth Management, we invite you to visit our website at pomwealth.net. If you go to the contact page and contact us, we'll send you a free copy of our book, The Peace of Mind Pathway. It lays out our process from beginning to end. Please visit our website.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.